Hello there. If you've been here before, welcome back. And if not, I am Dr. Stock, Doctor of Education, and I'm glad to have you here. And if you do like this video, please hit the like button and hit me up down in the comments. Tell me what it was that you liked about this video and what else you would like to see on my channel. That can also go for returning people to my videos as well. I would like to talk about the overall markets and see what exactly allowed them to move up the way that they did, because we had some serious green in the markets today with not a whole lot of red going on for us. It did show up in spots such as with Goldman Sachs, for example. That would be one big company that would have not so nice of a day on a day that was otherwise pretty green. But I do want to talk about those markets and what impacted it in this video. I'll be featuring the Moomoo app, and you can find that link down in the description. 16 free stocks, and get with it and check this out. And we can talk about this more later if you want to. Making a deposit of $100 more, 5 free stocks, 1,000, 15 free stocks, and there's also $100 cash rewards up for grabs. And then when you look for a deposit of $5,000 or more, not only to get the 15 free stocks, the $100 cash reward, but also a free share of Tesla or Google. And I can tell you, based off the earnings projection that I've done for Tesla, that's the one that I would really want out of the two of them. Although I think that Google is a very solid company that still has a lot of upside coming up in their future, and that they have a lot of data on their side, and data is king in the AI world. And I think that they really stand a chance to do incredible things. NVIDIA is still my number one, being that they are in the hardware side of things, but on the software side, I think that Google still has a very strong and solid place, and I don't think that they're going to bow down to Microsoft, along with their OpenAI partnership that they have with that $10 billion stake into ChatGPT. We'll see how that plays out. Let's get on to the markets, though, because that's really, I'm guessing, why you're here. So let me pop over here, and what we're looking at now is Facebook, and I said overall markets, but Facebook's important because, well, it's a really darn big tech company, and they announced their new version of their headsets, and just in time, because next week Apple is expected to announce a headset of their own, and we'll see if the Meta Quest 3, I believe that it is available for about $400 price tag, or maybe no, it's a $500 price tag that they have on it. We'll see what Apple has to do with it. It wouldn't be the first time that we saw in big tech that a company comes out and undercuts on a timeline just before some other company reports, and that they come out with a superior product that the other company is just working on. I feel like AMD and Intel had that happen years ago, that Intel was working on something big, and the big announcement all got washed out because before they could make it, AMD made an announcement and the specs just absolutely obliterated what Intel had. It's been a long time, and I might be talking like early 2000s. So this could be 20 years ago, and depending on the age demographic, there are a lot of you who are in here with me. I'm at 40 years of age, and my prime demographics that people seem to tune in for are 25 plus. So, maybe some of you kindergartners out there, and for those of you older than me, if you're into tech, maybe you can recall that. If it wasn't that, it may have even been, NVIDIA, maybe with one of their graphics cards, but I'm pretty sure it was AMD and Intel. Let's move on from there, because I do want to talk about the market. So moving into the Qs, we can see the last, we popped up and then sold off, and that was a little bit unfortunate for us. But then we had this little doji candle, and I said, that's a lot of indecisiveness between the bears and the bulls, and it's possible that we see the market pop back up. And we did, along with that debt ceiling news that we had from late last night, that so far we've been green lighted to go ahead with it. We still have to have it settled by Monday, June 5th. There's a lot of pressure that goes on that day. I think that will be okay, and it looks like so far the market also thinks that will also be okay. We're still looking really strong, actually overbought on the RSI. For the Qs that we're looking at right now, which tracks the Nasdaq 100. So that's important to pay attention to that as well. And it is possible that we see just a little bit of softness. And I've been mentioning that in my videos. And I think that would be understandable. NVIDIA so far, not really letting up. They had a 5% day, and they are enormous in the Nasdaq 100, which the Qs track, and also a huge influence in the overall Nasdaq in itself. So keep an eye on that. Let's take a look at the SPY right now that tracks the S&P. And the SPY, quietly crushing it, not quite as well as what we've had. Now, mind you, the SPY doesn't have the heavy weights of big tech that Nasdaq does. There's it's the 500 biggest companies stateside that we have. So when we look at this, they're having trouble right now breaking this resistance that they have at about the 420 level, moving up to 430, which these are about, if you multiply by 10, you're about where you're at with the S&P itself. So this is about the 4,200 level. And then if we moved up to 430, that would be at the 4,300 level, thereabouts. It's not exact, it's not perfect, but it's pretty darn close. And I am concerned that I keep seeing the RSI fail to really give us significant momentum, that we have still some bearish divergence in the SPY to pay attention to. And we really want to keep an eye on that. And really, all of this movement that we have right now, let me go back to my web browser. There we go. And I'll pop this up for you as soon as I switch over. And here's what the market is moving on right now. We got non-farm payrolls coming out. Let me see the private side. Those what we want. So ISM. There you go. Challenger job cuts. Actually looking pretty soft. It looked like 92,000 was expected. Came in at almost just over 80,000. ADP employment change. So we're looking at a private sector for this. 278,000 versus what was expected. I believe Wall Street had at 180,000. Now the consensus on trading economics here is 170,000 to 200,000, and we were up significantly above that, coming in at almost 280,000. And so that puts the eyes onto the next jobs report that we get, which is tomorrow on non-farm payrolls, and they say 190 to 180,000. Honestly, I wouldn't be surprised if we came in just above 200,000 again, like 230-ish thousand to 260,000. I realize that crosses over that rounding wise. It would be 260,000 is closer to 300,000 than 200,000. But still, if we go to, let me see, bring this up for you. What we're looking at here, this is all employees total non-farm. So this is non-farm payrolls. And then we also have from private. So this would be the data that come from ADP. So blue is non-farm, which comes out tomorrow. That's why you can see it kind of ends shortly here over what the other one does. Pop that out for you. There we go. So the blue ends short because we didn't get the May report yet. That comes out tomorrow. The red, however, is the ADP that we got. So the 278,000 jobs that you see happening there. So it is important to look at that. And what I want you to see, if I can zoom out a little bit more for you, several things. One, they don't totally move together, but they somewhat move together. So there's some correlation that goes on. I don't have that statistic, although that is something that if we wanted to cook up an R value for something like that, a correlation coefficient between the two of them, that, you know, we could really see how one compares to the other. And I think it's going to be pretty close. I think there's a fair amount of significance that go along. You got some waviness and some wishy-washiness where non-farm dropped a whole lot more in the at the onset of the pandemic compared to private, and also spiked way up as a balance. And then it's sort of been settling. But let's go back out to that big view. And you can see even prior to the pandemic, and what has followed, yeah, we humped up for a little bit throughout 2022 when we were going back to hiring, and we actually needed to get people back to work. So that was a big hiring time. And after that, we haven't really seen significant changes out of what's typical. And so in terms of recession, we could say that the jobs data just isn't showing us recession. And so let's go back to the jobs data and let's take a look back at the Great Recession. You can see how it dips down below in that gray area there. And then when we look back to the dot-com bubble, how we had some recessionary times there as well. And we dropped down below for a while. And then you can see that also in the early 90s. And then you can also see that in early 80s. So you get the picture from this, that when we have the recession along with the weak labor market. Now, mind you, I think recession we'd have to always look back to see that we're in that technical recession, those 2 quarters of negative GDP. And that jobs data could be something that follows the weakness. So that would sort of lag a little bit, if you will. And right now, like I said, jobs data isn't showing us that. And it all comes down to the federal funds rate. So here you go, the CME FedWatch tool for June, still looking like pause. And we just want to see that non-farm payrolls doesn't change that pause happening for June. And there's also a lot of talk about July right now about the pause and then possibly spike up in rates. And you can see when we go here that, you know, we do possibly have a little bit significant, more of a significant chance of that further rate hike rather than a pause. So right now, 500 to 525 basis points, and that's what's current. You can see that if you scroll down below. This is just type into Google CME FedWatch tool, and you can see this. And if we go to July, bumping up another 25 basis points, that's what puts us there, not too far away, about 10% away from having half that chance from where it's at right now. I should say 10% of 45.5%, just to clarify. I know it's only 4.5% away from that chance of actually hitting that. So just being a math guy, I figured I better clarify. And you can see this over in the Reuters article. This came out 4:06 p.m. And I guess I looked at this at about 4:15. It's about 5 o'clock Eastern time as I record this video. Wall Street rise on hopes of Fed pausing hikes. That's what we currently expect. We don't want non-farm payrolls to change that. And so if we get really significantly high numbers for the non-farm payrolls, that could be something that puts a lot more pressure on the Fed in order to raise hikes for June. So we'll see that if it comes in pretty much as expected or something close to expected. I think we actually have a fairly wide range in non-farm payrolls before it even really matters to the Fed to even change what they do. I think we'd have to see a very, very strong number to change the Fed's mind. Even if I think it's less of a number that it would take to rattle Wall Street. I think if we get 300,000 plus, Wall Street gets rattled. I don't think it changes the Fed's mind. And we can always see what the CME Fed Watch tool through what the bond market is doing with that information. So the overall markets, they're looking pretty good so far. The S&P slow and steady wins the race, although we do have that bearish divergence with the RSI. Is it possible that we see some sort of pullback? It is possible, maybe in Q2, and we see some rotation coming into different areas. Maybe we see a little bit softness from earnings coming out as July reports. Maybe we just see a little bit of settling with some of the other stocks that have run up recently, especially talking about the Nasdaq and big tech. I think that is due for just a small correction, something to just give the bulls a little bit of time to rest, and then I don't mind if they march onward. I do still have my short hedge for those of you out there. It is something just in case the market does pull back. I don't want to be selling at the bottom since it's an inverse position and right now we're at a top. Selling at the bottom, especially when I expect a pullback, I might take just a little bit off out of that short hedge position. I've been holding on to it longer than I want in the first place. So that Moomoo app, that's what I've been showing in this video. Like I said, that link is down in the description. Take advantage, sign up, deposit your cash, and get your free stocks and that $100 cash coupon that comes along with your deposit. And if you have that money to put out that $5,000 deposit, and remember, that is still your money. Not only are you getting 16 free shares, but you're also getting a free share of Tesla or Google on top of that. And that's an incredible offer. If you guys like my commentary and would like to hear more of it, check out my link for the Patreon, which is also found down in the description. I am Dr. Stock, Doctor of Education. We'll see you in the next video.